Okay, so let's walk through this once again. From checking the resident ledger, moving in, get the billing in, we're going to post charges, just so we take it from the beginning. And we're recognizing the revenue for that first month, and then we're recognizing that community fee. And in this case, there was a concession, right? And we can play with this because no matter what the concession is, our example is going to account for it. So if we did give a full community fee concession, then that would be recognized here. Notice that means that there wouldn't have been any cash in the bank, because that means they did not put a deposit down at the time they were going through the reservation process. We just that was the incentive at the time, and so now they just move right in. And so when you do have that scenario, even though there's a wash, we still want to show that, which is why we still recognize the full 2,500. In this case, we would recognize the full 2,500 incentive. Hence the fact that the resident did not pay anything until they pay their prorated rent. And so when they do that, deposit into the bank, pay the prorated rent. Now the only cash that we have in place is that, because they got a full incentive for the community fee. Okay. And then from there, right, we would go into, we're going to bill the next month. Right. So, I want to stack some scenarios in place. So we got a profit and loss statement that's going to look at, we've got a monthly profit and loss statement. So we got July, August, September, and October. And we like P&Ls like this because we can identify trends. In addition to analyzing the P&L against the a budget, and we have a budget versus action, we can look at variances. This is good to identify trends and see things that are missing, especially on the expense side. So in this case, we billed for the month of August. And so we know in our space, typically we're going to bill anywhere from the 20th to the 25th, right? So July 20th, July 25th-ish, we're going to bill for the next month. So we would bill, that's going to hit the ledger. So you see we had some additional residents that moved in, which is what the scenario is going to talk about, which is why we got more income. So for this first resident, assisted living, right, there was prorated in July, which is what our previous example showed. Now we got the full month billing in the month of August. So that's the full month. We also had a memory care resident come on. And so in this example, they came on the beginning of the month. So we got a full billing there. And then we got a full billing for an independent living resident that came on, and again, full month billing there. So if we had 2 additional move-ins, we got a community fee that we want to recognize for those 2 move-ins. So going with that same scenario, 2,500 per community fee. So that's why that is 5,000. Again, just understanding what the financials look like. And so when we did the billing and did the move-in process for these 2 additional residents, then we're going to show the community fee income. And obviously we would have had the interaction with the balance sheet as well at the time of reservation. So we've already kind of covered what that looks like. And then in this case, we also had an incentive that we put in, and it was an incentive for this first month. And since it was a full month, we've got a full incentive, which is why we have the corresponding incentive there, bringing this down. So this resident, we wouldn't get a check from this resident until the following month when we bill. So I'm going to circle back to that, but we've got an incentive right up front. We did it at the time of move-in, and we've recognized it in the month that it applies to, which is important. So we've got gross revenue, but then we got a net revenue of the 17.5 because we got the incentive. Okay. Now we're going to look at, we're going to do a next month billing. Okay. And yes, obviously AR is growing, and we should have been collecting checks, right? So we don't want to get in the situation. We've billed August and we billed September. We still have no checks. But the purpose of this example is to look at the monthly billing and talk through a couple things. So, you figure August 20th comes, August 25th comes, and we look to bill September. In this case, we billed September. Well, we're pretending that we didn't have any additional move-ins, so there was no community fee income to recognize. No incentives. So we were able to get residents in the door. No incentives there. So we've got a gross revenue that matches our net revenue because we don't have any incentives.